All right, we are going to break down one of the most incredible, most spectacular corporate flameouts in modern history. This is the story of WeWork's insane $47 billion collapse.
So let's start with the central mystery, the big question at the heart of it all. How on earth did a company that, at the end of the day, just rents out office desks, convince some of the smartest investors in the world that it was worth $47 billion? It's an amazing story about vision, hype, and a collision with cold, hard reality.
I mean, just take a second and let that number sink in. 47 billion. That was WeWork's valuation before it ever sold a single share on the public market. Private investors decided it was worth more than giants like Hilton Hotels or Delta Airlines. It's just wild.
Okay, so to get our heads around that number, you really have to understand the two sides of the WeWork coin. First, there's the incredible story they told, and then there's the actual math they were trying to keep hidden behind the curtain.
And this, right here, this was the secret sauce. This is a direct quote from their IPO paperwork. Listen to that language. Elevate the world's consciousness. They weren't selling office space. They were selling a revolution, a tech-driven movement, a community, a vibe.
So this really just cuts right through all that marketing fluff. The pitch was that they were a technology company. The reality? They were a real estate company. They talked about flexible community hubs, but what they were actually doing was renting desks and losing an astronomical amount of money doing it. And here it is, the ticking time bomb at the very heart of their business model. You see, WeWork had these huge fixed costs. They were locked into 15-year leases with landlords, but their income, that came from customers who could just pack up and leave with only a month's notice. In a good economy, maybe you can juggle that. But in any kind of downturn, it's an absolute recipe for disaster.
And this chart, wow. This shows you exactly what happens when that flawed model hits the real world. Just look at these numbers from 2018. For every single dollar the company brought in, it lost a dollar. Think about that. The faster they grew, the more money they burned. It was completely unsustainable.
So you're probably thinking, how in the world does a company losing that much money get a $47 billion valuation? Well, the answer is a potent cocktail of venture capital hype and the larger-than-life and deeply controversial co-founder at the center of it all, Adam Neumann. The whole company was basically set up to give Neumann total ironclad control. I mean, we're talking about shares that gave him 20 times the voting power of a regular investor. And get this, he was cashing out hundreds of millions of dollars of his own stock before the company even went public. A massive, massive red flag that somehow private investors just decided to ignore.
But it wasn't just about control. It was about how he used that control. There was this clear pattern of what looked like blatant self-dealing. He literally trademarked the word "we" and then made his own company buy it back from him for millions. He bought buildings and then leased them back to WeWork. The company's bank account was basically treated like his personal piggy bank.
You know, for years, all of this, the insane losses, the weird corporate structure, the self-dealing, it was all hidden away. It was a private company, fueled by what seemed like endless buckets of venture capital cash. But then, they decided to step into the sunlight and go public.
And this document, the S-1 filing, that's what blew the whole thing wide open. Think of it like a mandatory confession before you can sell stock to the public. You have to put everything on the table, the good and the bad. And for the first time, all of WeWork's dirty laundry was on display for the entire world to see. And boy, did they look.
The reaction from the public market was immediate, and it was absolutely ruthless. In just over a month, about 40 days, the entire house of cards came tumbling down. The valuation just evaporated. What's so fascinating is that the public market investors instantly rejected the very same things that private investors have been pouring billions into for years.
All right, so after the IPO spectacularly failed, what happened to the company? And maybe more importantly, what can we all learn from this incredible corporate train wreck?
Well, to stop the company from completely bleeding out, its biggest investor, the venture capital giant SoftBank, had to step in with a massive rescue package. It's kind of ironic, right? The very people who had pumped up the valuation to those crazy heights in the first place had to come in and try to save the company from itself.
And here is the part of the story that just makes your jaw drop. As part of that rescue deal, the founder who was just forced out, the man who presided over this entire disaster, he walked away with a golden parachute worth $1.7 billion.
Meanwhile, what about the regular employees, the people who actually built the company day to day?
it was a totally different story. Thousands were laid off, and those stock options they were promised would make them rich, poof, gone. Basically worthless overnight. So what happened next? Well, the company's journey since then has been rough, to say the least. They did eventually manage to go public, but for a tiny fraction of that original number. Even that wasn't enough. The company ended up filing for Chapter 11 bankruptcy and has since emerged as a much, much smaller version of its former self.
And that really brings us to the big, lingering question from this whole saga. When a founder can oversee this level of value destruction, can lead a company to the brink of collapse, and still walk away a billionaire, what message does that send? It creates what experts call a moral hazard. It basically forces us to ask, where is the accountability? And that is a question the entire startup world is still trying to answer today.